After a decade-long bull market, what can you really expect from stocks? What's that average stock market return look like? In this video, I'll not only show you the history of bull and bear markets to find that reasonable rate of return, we'll look at what's caused stock market crashes in the past, and more importantly, what investment returns you can really expect in the future. We're talking stocks and investment returns today on Let's Talk Money.
Beat debt.
Make money. Make your money work for you.
Creating the financial future you deserve.
Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in our community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, the market has been absolutely crazy lately, and I'm not talking about the up and down roller coaster we see so often in stocks. I'm talking about the expectation that these good times are going to last forever. Over the last 10 years, stocks have more than doubled, and only with a couple of small corrections along the way. Now, the financial pundits are again telling people to expect those double-digit returns, and nobody's questioning the sanity. This just is not normal. This is exactly where you want to take a step back, a look back, and a little reality check in those numbers. Now, I'm not calling for a stock market crash here, or even trying to predict a recession. What I want to do in this video is just give you a realistic idea of the average stock market returns, bull and bear markets, and what you can expect from investing. I am not trying to rain on your parade, and I really don't want to be the pessimist here, but I do want to do two things. First is by giving you those realistic returns, those realistic investment returns, you're going to be able to better plan how to reach your goals. You see, a lot of people expecting those 10 plus returns to go on forever, they're just going to get disappointed when returns fall short and they haven't saved enough. You're going to be able to see exactly how much you need to save on these more realistic returns. Second, though, is by readjusting your expectations for returns on stocks. Now, I'm hoping here to keep you from those bad investing behaviors that just kill a portfolio. Knowing what's realistic for stocks, bonds, and real estate returns, you're less likely to chase over those hot stocks and then panic sell when they don't live up to the hype. So let's look first at this data by McKinsey Investments on the composite S&P and TSX index. So this is going to be US and Canadian stock markets, and we'll look at some bear markets going back to the 1930s, but I like to use this broader data back only to 1956 for a more modern perspective on the markets. There have been 12 bull markets since 1956, though there's some argument as to whether that 2001 gain was really a bull market or just a quick bounce in that 2000 crash. Now, on average, stocks have jumped 129% from the low of the previous bear market and have rallied for 54 months. Now, on that last point, it does seem like bull markets are lasting longer than they have in the past. 5 of the last 7 bull markets have all been over that 54-month average, so the number could be skewed a little lower by older data. Now, there have also been 12 bear markets of a 20% drop or more since 1956, with stocks falling an average of 28%, and for that plunge in prices lasting an average of 9 months from the previous highs. So now, a couple of points to get from this graph before we look at some of these other things like what caused the bear markets and the average returns going forward. First is that current bull market is definitely not typical. 10 years of almost straight up stock prices is a long time to go without a hiccup. Even if we consider the bull markets are getting longer than they have in the past, 10 years is more than double that longer-term average length. Also, though, that 176% return since 2009 might be above the average bull market return, but it's not what you would expect from a 10-year-old bull. It's one of the things that optimists have pointed to as to why the market can keep going. They're saying that basically that stocks haven't exactly boomed like they did in the 90s, so there isn't that sense of euphoria and overprice that you usually get before a crash. Now, if bull markets don't die of old age, what does cause a crash? What are the factors that usually bring a stock market crash, and are they a threat to your returns now? Now, recessions and just that fear of a slowdown in the economy are the most common reason for a stock market sell-off. And more than half the past 12 bear markets have been caused by that outlook for a negative economic growth and higher unemployment. Now, on this one, we don't seem to be in too much trouble just yet. Unemployment is still at historic lows, like 5-decade lows, and wage pressures aren't to the point where they're hurting corporate profits and driving those layoffs. There is some worry about manufacturing, though, and recent surveys point to an industrial sector in the U.S., the slowdown in that sector, but it's not bled into the rest of the economy. Now, the biggest warning signs are that developing trade war and the potential effect on consumer prices, but no real sirens yet. Extreme stock valuations have also caused bear markets. In 1981, 87, and the 2000 dot-com crash. Stocks are an ownership of future profits, so the value is tied to those expected cash flows. Normal here would be for stock prices to rise at about the rate of earnings growth. Now, when investors get overexcited, enthusiastic, stock prices detach from that intrinsic valuation. Now, this chart from FactSet shows the forward price to earnings ratio for the S&P 500 and the 11 stock sectors it tracks. Now, most of the time you're going to hear this price to earnings ratio, you're looking backwards. So stock prices divided by corporate earnings over the past year. This forward price to earnings ratio, on the other hand, is just stock price divided by earnings analysts are expecting in the stocks in each sector and in the economy as a whole over the next year. It's a little different, but still useful in the comparison that we want to do. So the chart shows that current forward PE ratio in the dark blue bar here, along with the 5-year average in light blue, and then the 10-year average in green. What you immediately see is that stocks are getting more expensive in almost every sector, with that current PE ratio well above the 10-year average. You're taking a closer look at these numbers, and you see how expensive some of these sectors have become. The overall market itself, the S&P 500 is trading at 17 times the earnings expected over the next 4 quarters, over the next year. That's almost 15% more expensive than that 14.8 times average over the last decade. Even more expensive though, you've got sectors like information technology trading more than 30% over its 10-year average. Now I've added the percent premium on the discount above each sector so you can see just how expensive some of these sectors are. In fact, the only sectors that don't look dangerously expensive are energy, which is still reeling from that 2014 sell-off in oil prices, industrials, healthcare, and financials. Now understand, when I say dangerously expensive, it's from the perspective of a die-hard value investor. I hate buying stocks when they're even a little bit expensive, so yeah, a little biased on this one. Now the truth is that stocks aren't ridiculously expensive, not compared to some of those other bull markets that we've seen. And not to the point that we saw in the dot-com bubble or the 70s and the 80s. Even if stocks were trading at those higher prices though, this isn't one that usually causes a crash in itself because investors are perennially positive. It's those nosebleed valuations that make it more likely that some of these other catalysts, for example, the Fed raising interest rates like it did in late '99, is going to start that crash. Now, speaking of the Federal Reserve, that's another common cause for falling stock prices, though I hate to put the blame on the Fed. Look, the people on the Federal Reserve Board are public servicers, very highly educated and experienced ones, just trying to help the economy avoid some of those worst outcomes. Their mission is twofold: full employment and stable prices, but these are sometimes competing missions. Full employment is great, but if it comes at the expense of consumer prices surging as much as 13% a year, like it did in 1980, then the Fed has to raise rates to fight that inflation. Even worse though, sometimes we get inflation without the economic growth, and then the Fed has to walk that even finer line. Sure, it might be politically easier if the Fed just kept throwing money into the system, but it's just not responsible, and in fact it would leave the central bank with no ammunition to lower rates when a recession does come. So anyway, the Fed has been blamed for a few recessions and bear markets in the past, especially in the 80s when Chair Volcker took short-term rates to 20% just to fight inflation. Right now, it doesn't seem to be the case, though. While Chair Powell isn't giving President Trump that 0% interest rate he wants, the Fed is cutting rates to keep the economy going and growing on a stable path. Now, finally, before we look at those average stock market returns over the last decade and what to expect going forward, understand that external shocks can also cause stocks to fall. Nearly half the bull markets since the 30s haven't coincided with a recession, in fact. Now, against those main causes that we've already looked at, there are usually unexpected and external shocks that come into play. Some examples include Hitler's invasion of Poland in '39 that brought a 32% drop to the market, the attack on Pearl Harbor in '40 that was a 35% plunge, the '61 flash crash that took stocks down 28% and has never really been rationalized, and then the currency crisis in '98 that saw markets drop 20% before heading higher in that dot-com bubble. Now I want to look at those average stock market returns over the last decade and maybe why you should look further out for what to expect in real stock market returns. So the S&P 500 has risen 11% on an annualized basis since 2009, more than 10 years, but is that really realistic? Okay. If stock prices are a function of that earnings growth and corporate earnings grew at less than 5% year over year last quarter, how long can stock prices surge higher? In fact, the average annual return since 1957 is 8%, and we're going to look at some analysis next that shows returns could be even lower than that over the next decade. First though, I want to get your feedback. Do you think the stock market crash is coming? Of the reasons that we've looked at it before or others that you've seen, which are the biggest warning signs of that potential bear market, whether next year or the year after? So scroll down and tell us in the comments, when do you see the next stock market crash? Now, before we look at that research on stock returns going forward, it all begs the question, what's a good return on your investment? Now, the question itself is dangerous at best. Is 4% good? Why not 8% or maybe even 15%? Reaching for that arbitrary return just means investors keep reaching into more risk and eventually are reminded what happens with that risk. So a good return really is then just getting the return that you need to meet your goals. And that means knowing what your goals are in the first place and then a reasonable return to get there. It's something I talk about a lot in a free webinar that I'm planning on, a goals-based investing strategy. This is the strategy that I developed working with private wealth managers and aligns your investing back to your own personal goals. So I'm going to put a link to that free webinar in the video description below, so make sure you check that out. I had planned on looking back to show you those average assets by returns, but instead I want to look forward here. That's what we're really talking about, right? That's what's really important. Those returns that you can expect in the future rather than what we've seen in the past. So let's look at some research by fund provider BlackRock estimating the 10-year expected returns and what it means for your investments. What we see here is a chart of 21 sub-assets. That's 12 types of debt investments, 5 equity investments, real estate, and some alternative assets. The chart shows the forecast returns with circles and the uncertainty around each asset type. For example, there's a huge uncertainty around private equity returns, that far right bar. The average expected return is 13.2% a year over the next decade, but in actuality, it could be near 0 to over 25% return a year. That's a combination of the uncertainty in the research plus that normal volatility in that alternative investment like private equity. Now we're going to look at some of these, but understand that these estimates are nominal returns. That's without adjusting for inflation. So these are the headline returns that BlackRock, the investment manager, expects, though inflation is probably going to eat away at about 2% of the value in each of these. Now I've highlighted 6 investments here in 3 assets, stocks, bonds, and real estate, with the exact estimate for 10-year forward returns. So we see that U.S. government bonds, that 10-year treasury, is expected to yield a 1.7% return over the next decade. And U.S. bonds are actually the bright spot. Globally, more than $15 trillion in government debt trades for a negative interest rates. Germany's 10-year bonds is a negative 0.6%, so people are actually paying to hold their money in the bonds. Now that means investors all over the world are pouring into U.S. Treasury debt for that positive return and pushing down those longer-term U.S. rates. Bond returns have been great this year on a huge slide in rates, but that expensive valuation means returns going forward is probably going to be weak at best. Now there's no end in sight to the rock-bottom global rates, and this is going to be a real problem for retirees, pension funds, and insurance companies that need a safe and stable yield. U.S. credit, so investment-grade companies, are expected to yield a little more than 2.3% a year over the decade. That in itself is pretty amazing that companies are going to be able to borrow at rates so low. We're already in a corporate bond bubble with debt piling up on balance sheets, and this is actually one of the most likely causes of a coming crash that I've seen. Now, high-yield corporate bonds are expected to yield 4.7%, but before you rush out to put all your money in non-investment grade debt, remember, these are also called junk bonds for a reason. These companies are going to get slammed when a recession does hit, and the return could be much lower than that average estimate. Next here are these U.S. equities. So we're talking about the S&P 500 here is expected to return around a 6% return over that decade. That's a pretty far cry from the 11% return over the last decade, and I know a lot of you are skeptical about it. Just understand there will be a recession, likely more than one in the next decade, and probably within the next few years. It's all but guaranteed. Just looking back at that bull versus bear market history earlier, and you see where a crash can wipe out a third of the market in a heartbeat. So even if you don't agree with that 6% return estimate, I think 8% is probably going to be the best anyone can hope for. Remember, we're already at those high price to earnings valuations. Interest rates are already extremely low and not really helping to drive that economic growth. There just isn't a lot of positive signals for stocks. Now, small cap stocks, so those smaller companies that are more risky but supposed to produce higher returns, they are expected to do just that with a 6.3% annual return over the next 10 years. That's not much extra, but it adds up, and I think every investor should have some exposure to these small caps as well as some of those larger companies. Now, finally, look at the expectations on real estate, because I think this is really interesting here. Now, BlackRock expects U.S. commercial property to actually underperform stocks, producing a 5.3% annualized return over the next 10 years. And I think a lot of that is the assumption that rates are generally going to be going up over the period because they're so low right now, and rising rates are mostly bad for property investors. The uncertainty on that real estate forecast is also interesting as well, much wider than the large cap stocks. So while property is expected to underperform the S&P 500 by about 0.7% a year, it could do much better or much worse. Now, 2 things I think you should take from this chart. One is that returns are likely to be lower over the next 10 years compared to the previous decade. If you're planning on your nest egg getting about 11% returns, you're going to be disappointed and just not saving enough. Plan on a blended portfolio of stocks, bonds, and real estate, and producing maybe around 5% if you're lucky, and save accordingly. Also though, notice that there's a lot of uncertainty around each of these estimates, as stocks of large companies are expected to produce a 6% annualized return, but it could be in the low single digits or as high as 10% over the next decade. And that means you really need to be mixing these different assets, putting a portfolio together of stocks, bonds, and real estate. So it's not just about going all in stocks and hoping for that 10% annual return. It's about spreading your risks around to make sure you get that safety of bonds and the upside potential of some of these other assets. Click on the video to the right here to see my 5 favorite monthly dividend stocks that will never let you down. No matter where the economy goes, these stocks will continue to pay out those cash dividends every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.